Time now for On the Radar, a closer look at what a money manager is watching in the markets these days. Gavin Graham is Portfolio Manager and Chief Investment Officer at Spire Wealth Management. And we're going to talk about gold, Gavin. Investors who have been long gold for the past year or more are pretty glad that they've done that. Talk to us about gold as an asset at times like these.
Absolutely. Well, again, gold is sometimes regarded as portfolio insurance in the sense that it will actually is not correlated with any of the other major asset classes, whether it's bonds or equities or indeed cash for that matter, or industrial commodities. It's therefore tends to be a store of value, and particularly in times of economic uncertainty, because it's something that's essentially preserved its purchasing power over the last 2,500, 3,000 years. It does tend to come into its own. So we're up about 25% over the last year, and you're still actually up 15% or so this year, even though you're down 10% in the last few days for gold miners. Gold is off about 5% itself, but it's also up for the year at a time when the equity markets are down. And one of the reasons, obviously, is concerns about uncertainty, geopolitical uncertainty, and also some concern about inflation, because firstly, if you do have the imposition of tariffs, there could be higher prices for goods. And also, what's the government response to that going to be? Is it going to actually be printing some more money through a quantitative easing program to help offset the effects of a downturn caused by tariffs? So in general, gold is a pretty good place to be, and looks likely to continue to be so. A large number of Wall Street houses, although their forecasting ability is generally no better than anybody else's, but they're all raising their gold price forecast to 3,300, or even, I heard this morning, 3,600, which is only barely 20% above where we are now. And generally, gold miners tend to be a sort of operationally leveraged play on the price of gold. So if gold goes up, then all of that profit drops straight to their bottom line. And certainly for the last year or so, they've been doing better than gold. But interestingly, they've lagged over the last 5 years because the two biggest gold miners, Newmont and Barrick, haven't really done a great deal because they've had some operational issues.
So the vehicle you like in terms of exposure to the sector is the miners, first of all, rather than exposure to the pure metal, and you prefer basket style exposure, ETF type exposure. The ETF you like is XGD in Toronto, the iShares Global Gold Miners ETF, and that I believe is market cap weighted, correct, Gavin? So the giants like Barrick and Newmont have a larger footprint here than smaller companies do, correct?
They have, and as a result, that, as I said, they've actually not gone anywhere remarkably enough in the last 5 years, even though gold itself is up 75%. But they now are starting to get some momentum because people are going, oh, we ought to have some gold. Let's go and buy either the biggest companies directly, and Newmont, I think, is the only gold stock in the S&P 500. But alternatively, let's buy ourselves a gold mining ETF. So that gold mining ETF has started to outperform against gold over the last little while. There are some excellent Canadian gold miners like Agnico Eagle and Alamos, Pan American Silver, who have actually done a lot better than the ETF itself, but the ETF is an easy place to start. And as mentioned, there is money coming in, and the money tends to buy the biggest stocks to start with.